Welcome to the Types of Borrowing podcast, where I talk about different types of borrowing. Before we start out, I just want to talk about two vocabulary words, appreciation and depreciation. Appreciation is a positive thing because it's when the value of what you own goes up over time. Depreciation is the opposite, so when the value of something goes down. Now, there are different types of loans I'm going to discuss, some more in depth than others, but we have a general type loan, a real estate, student, car, collateral, and payday loan. For a general loan, I'm just talking about something that you're borrowing that doesn't fall into the other categories. So it's money that you may be borrowing to pay for a big screen television or to pay for furniture or to pay for appliances. And you can get a general loan from a bank, or often you can get a general loan from a store that is selling the product. A mortgage is something I'm going to talk a little bit more about in depth, and that is when somebody buys property. And property is also known as real estate. With a mortgage, usually mortgages last 30 years. 15 years is also one that is not uncommon. And actually, the buyer doesn't really fully own the property until they pay their mortgage off. So it can always be taken from them if they stop paying their mortgage, which you'll learn about in a couple of slides. Now, real estate means land pretty much, because you're actually buying the land that the house sits on as well as the actual house. And so that's just important to know. There are two different types of real estate loans. There's a fixed interest rate loan and a variable interest rate loan. Now, the fixed interest rate loan is probably the best type that you can get, which most people do actually get, and that's where the interest rate is the same over the course of the loan. So for 15 years or 30 years, you're going to be paying the exact same amount per month because the interest rate never changes. For a variable interest rate loan, the interest rate can change depending on what the going rate of interest is in the market. And so you might start out with a really low interest rate, but it can adjust itself to be really high depending on whether interest rates rise as per the Federal Reserve. So you could start with a really low mortgage, and in 10 years you can end up paying more, like $200 more a month or something like that. So it's usually best to go with a fixed interest rate if you can. Now, if you don't pay your mortgage, as I had mentioned previously, you can get your house taken away. Not paying your mortgage is called defaulting on your loan, and it's when you just don't pay it. It's different than just missing 1 month and working with your lender to figure out how you can pay that back eventually. It's not paying for a certain amount of time. To the extent that your lender decides they're going to take your house. And that process under which they take your house is called the foreclosure process. So when you say something has gone into foreclosure, it means they have started that process of being able to take away the home. In general, though, real estate is a good investment because real estate does appreciate over time. It doesn't always appreciate quickly, and it can go up and down a little bit, but in the long run, especially with inflation, real estate prices are just going to grow. And you can see on this graph from 1960 to 2020 that real estate prices have grown steadily over time. Even though there was a dip during the Great Recession in 2008, 2009, they still have gone up a lot since then. The next type of loan is a student loan, and it's pretty much what it looks like, borrowing for education. You can borrow from a commercial bank or you can borrow from the federal government. The federal government does offer lower interest rates, but not everybody can actually borrow from the federal government, and there are some reasons for that. One of the reasons that you might not be able to borrow from the federal government is because it is based on need to a certain extent. And so, if your parents make too much money and you are under the age of 25, you might not be eligible for that type of loan. And also, it's good to know that some student loans, like federal loans, have limits on how much can be borrowed. So, the rest of the loans might have to come from a commercial bank. In general, student loans are a pretty good investment because having a higher education leads to a lot more earnings over time. And so, as much as people have a lot of debt and it can take a long time to pay off that debt, generally speaking, student loans have a good return on their investment. As I said, student loans can be a good return on investment, even though people over time have been having to borrow more money in order to pay for their education. However, the difference between not having a college degree and having a college degree is very different in terms of the amount of earnings you see over time. So, over time, you're going to make up that $35,000 average loan that you might have. You're going to make more than $35,000 more over time by having a degree. Although people have more loans nowadays, even as they get older, people who are by the age of 50 have mostly paid off their loans. So it seems like a long time to have loans for, but you will eventually pay them off, and it is worth it to have a student loan. What's more important to think about is how much debt do you want to have? And so that could be the difference between going to a state school versus a private school. The next type of loan is a car loan, and it is what it sounds like. Car loans are usually stated in months, so 36 to 60 months, but it's 3 to 5 years. And you can actually get a better interest rate on your car loan if you have good credit, meaning you've been financially responsible. And that's actually the same thing that goes for when you get a mortgage to buy a home as well. You get a better interest rate when you've been financially responsible. You can get a loan from either a bank or from a car dealership. It used to be that banks were definitely better for getting car loans because they gave you better rates. But nowadays, a lot of car dealerships will give you good rates and deals as well. And so, a car loan, in terms of an investment, is dependent on whether you think it's worth it. In general, cars depreciate as soon as you drive them off the lot. Some cars hold their value better than others, and you are going to be able to sell the car in the future, but for a lot less than you bought it for. But you have to figure that if you're not living in a really urban area, it's going to take more time to use public transportation. So you're really investing in a lifestyle and having it be easier to go from point A to B. So that's really up to the individual whether or not they think the investment is worth it. Next up, there's a collateral loan. And really, a mortgage is a type of collateral loan too, because you're putting your house up in exchange for the loan. But in general, collateral could be anything that's used to be taken if you can't actually pay back the money that you borrowed. So if you decided to do a collateral loan for a boat, to buy a boat, and you put up your car as collateral, if you didn't pay back the money on your boat, then the lender could take your car. And that's basically what a collateral loan is. So now payday loan, our last type of loan, it's the worst type of loan that you could actually make. And it's basically getting a small amount of money for the really short term and paying it back once you get your paycheck. Payday loans are really bad to have because they have very high interest rates, and we're talking a few 100% as opposed to an interest rate like 5%. And you have to have a job in order to get a payday loan, but payday loans are usually reserved for people who are pretty desperate, who have nobody else they can borrow from, and who have maybe not been as responsible with their money as they could have been, so they have bad credit and can't get a loan from a bank. So they have to go with a payday loan. But you should only use a payday loan if you're going to be evicted from your apartment if you can't afford to pay rent, because you're going to be paying this loan back for a while due to the very high interest rates. Therefore, a payday loan is not an investment. There is no return on your investment. And as I said, it better be an emergency if you ever use a payday loan. And so there you have it. Those are the different types of loans that you should know. And I hope you've learned something. And I tried to make this one pretty quick. So have a great day.